This is Andrew Stotz of Stotz Investment Research, and I'm giving you a little warning that the dream factor is riding high in the US. Now, previously I've talked about what I call the dream factor. In reality, it's really the re-rating, in this case, of price to book. So it's the re-rating of a multiple, such as PE or price to book. Now, there's four things that drive the performance of any stock market. The first one is inflation. We get compensated for that. And the second one is real book value growth. I say real book value growth because we've already taken out inflation. And then dividend yield, and finally what I call the dream factor, this re-rating on an annual basis. So in this chart, I show every year since 2003 to today. And it is a cumulative chart. So we can see that I start this chart at 0 right here at the beginning. And if you put money in at 0, at the end of this time, you'd end up with 171 of terminal wealth. That's where the line is. So then the next thing I want to do is look at where did that terminal wealth come from? Which component? So over 13 years, inflation contributed 32%. Now that inflation in this case was 54 of the 171 total return, and that 54 is 32%. Now we can see that book value growth contributed 57 of the 171 return, and that's 33% of the return. So about the same for inflation and real book value growth. And then dividends contributed 33 of the 171 total return, and that was about 19%. And then finally, over this period of time, the cumulative impact of the dream factor was 27 of the 171, or about 16% of that total return of 171. Now, if you look at it over a longer and longer and longer period of time, you usually find that the dream factor actually is a zero impact, because some years it's great, some years it's high, some years it's low. But in this case, we are riding high since 2003, with the dream factor being pushed pretty strongly. That's a warning to me that the market is starting to look expensive. Have a great day.